Hey guys, welcome back to the channel McNallie Money, the official home of power mining analysis. In today's episode, Anthony Power and I are joined by Haley Thompson. He's the Director of Energy at Luxor Technology. We've got a long list of questions and really looking forward to this interview. Before we get into it, take a second, hit the like button guys. Big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join. Let us know in the comment section below if you have any additional questions about Bitcoin mining energy strategies, and we'll try and get those answered. With that being said, let's get into today's video. All right, guys, away we go. An exciting podcast today. Going to be focusing in specifically on the energy component of the Bitcoin mining space. We have Haley Thompson, Director of Energy, Luxor Technology, joining us for the first time on the podcast. And Haley, interestingly enough, you're based in Calgary, Alberta, as am I. So a fellow Calgarian, welcome to the program.
Thank you. Yeah, no, great to be on here. Excited to talk about it.
Yeah, this one should be good. We've talked a lot about energy strategy, the importance of energy pricing, fixed contracts, PPAs, floating energy prices, a lot of these topics on the channel. So you're the expert. We're excited to get into it. Before we do, though, can you give us an introduction on yourself and how you got involved with Bitcoin or Luxor and the whole orange pill moment there?
Absolutely. So actually in Calgary, where you're located yourself, I studied here, and as you know, Energy City, one of the main energy hubs in North America. And I started my career at a utility called TransAlta, a trading power. I was always just very interested in energy, and I kind of felt that power was this cheat, this hack where it didn't matter whether it was going to come from renewables or oil or coal. It was, this was a very useful form of it. And just became enamored with energy markets working at TransAlta. And early on in my career, actually my focus and specialization was how renewables are just taking over all these grids in North America. The renewable penetration, specifically in California at the time, but now we've seen it go everywhere, especially Texas, was just increasing, and there was all these unprecedented things happening. And what happened for the first time ever, really early in my career, was negative power pricing. So a power price that was negative, which is basically punishing the people who are producing power. The price signal saying, this is too much, like there's too much power here, or they're causing congestion, and just wrapping your head around that. So this is where kind of I started my career, trying to make money from these negative prices. And then it wasn't too long into that once I figured out what Bitcoin got on my radar through speculation, and number go up, number go down. But as that was my entry point. I'll admit it. But then I figured out what mining was, and with this knowledge of this negative power pricing, and then looking at a miner as just an incredibly dense form of power, a megawatt in the CCAN, that can just consume negative power. Doesn't even, the fact that it's worth something is great, but just the fact that it can do that, it lit up all these business ideas in my head of, okay, this is a tool that can solve a problem, and the market is screaming, somebody needs to come solve this problem. So that was kind of the beginning of my journey of the convergence of compute and power markets, or Bitcoin mining and power markets. And then actually at one point, kind of between jobs, I started my own Bitcoin mining company in Alberta here, but ended up actually going after the flare gas because of all the red tape involved with the grid. I decided, hey, it's a lot easier to just roll out into the field. And then that kind of started my second life, so to speak, as a Bitcoin miner. My introduction to Luxor was as a customer, using them as a pool. So that's how I got to know Luxor and the team and the product there. And then, fast forward a little bit now as the director of energy here, we're focusing on bringing the solution, being part of the solution. But yes, now we're taking on the red tape, full on, not shying away, and helping navigate that for our clients and customers.
That's an awesome update there. Now you've just mentioned, obviously, the moving into obviously Luxor and that role of director of energy. Can you sort of like give us an understanding of what your day-to-day role in the company is, and what sort of things that you're involved in on a regular level?
I would say we're building a suite of tools to help miners either make sense of energy from a reporting standpoint, but not only just make sense of it, but benefit from it, be active market participants. So we're allowing miners, and so we're focusing on Texas. So my day-to-day is very focused on Texas because it's just a very business friendly, very tech forward jurisdiction, and they have, I think, been the most successful looking at flexible loads and saying how can these resources participate in our grid in a beneficial way? How can they tap existing market programs? And they actually have a very, very good and forward thinking way of looking at our industry. And so it's building tools, but it's also going through the processes to help us be, and our customers be, market participants in ERCOT, in the Texas, the main Texas power market, the main Texas grid. And so I just refer to it as red tape. But a lot of what we've done is kind of setting ourselves up to offer services to miners, and we're focusing in Texas, but we want to expand across North America. And so an example of that is Luxor is a retail energy provider in Texas, which means we can actually provide an energy bill directly to our customers, and we're fully registered and fully compliant. And that was a big part of my work to date is setting that up. So we've done that in Texas. We'd like to expand through the Eastern Seaboard and all across North America eventually. And so that's a big part of the role. Another big part of the role is developing the strategies, refining the strategies, saying, okay, now that we can participate, how do we want to participate? What do our customers want? What's going to make the most revenue? What's going to give them the most certainty? And then finally, just working on the tools. And I feel as a Bitcoin miner, as a user of Luxor's products, that I'm basically building the tools that I would want to exist for myself if I was a Bitcoin miner, but from the other side.
In terms of tech, I mean, you mentioned Texas there. It is, probably the most saturated area for Bitcoin mining, probably globally. Are you seeing any sort of other states that are equally showing real potential? I mean, we know that a lot of other miners, the likes of maybe CleanSpark, operate in different states to Texas, and have done that quite successfully. Bitfarms too. Are you seeing potential for other states to, or is it the fact that the way energy is set up in Texas enables them to be, offering the best type of deals for Bitcoin mining?
It's a spectrum. So there's states that I would say, I almost prefer to answer that question in reverse. Like there's states that are awful, and like I will single out a place like California is a very hard place to do business, and probably the most likely to just put our industry in a pigeonhole and say, cryptocurrency mining, which is a term I have particular contempt for. I would say that there's a lot of amazing lobbying effort going on. There are organizations like the Texas Blockchain Consortium that do focus on Texas, but they're a model, and a lot of people are emulating those. And so we're seeing inroads in Tennessee. We're seeing inroads in PJM. New York is actually quite receptive. There's some Canadian ISOs that are looking at it a little bit differently. Canada is pretty bad. Like I think we have a few moratoriums in BC, and I think Quebec has gotten harder to enter. But Alberta, where myself and McNallie live, I mean, we just sat down with a round table, and we had the energy regulator in the room. We had the president of sustainability for the Alberta system operator in the room, and they understand that flexible load is part of the solution. In some ways can play a similar role to batteries. So it's gradual, and it comes in fits and bursts. But I would say, Tennessee looks pretty good in the United States. I think the key is not is not pigeonholing the industry as a universally bad thing, or looking at it as a bunch of load that just wants to gobble up scarce resources, but creating the incentives and the programs, which often already exist, to where we can be market participants. We don't contribute and not contribute to peak load, not contribute to scarcity. If anything, be part of the solution. But propping everything up in the base load hours, and then not being a consumer when the scarcity signals come in. And as a price responsive load, when power is scarce, it should be expensive. When it's expensive, most miners prefer not to mine. So that has been an education battle, but the regulators are starting to get it. I see the tide turning in lots of places.
That's great. Yeah, we just covered earlier today on a podcast talking about some of the AI red tape restrictions being eliminated by the Trump administration and this real push to onshore a lot of the data center capacity. So I wanted to pause for a second and just talk about the ways that energy is intermingled with Bitcoin mining. You would know this, I guess, firsthand as someone who had a Bitcoin mine yourself. Now you see it from the inside. We obviously understand the correlation between the price of energy and the input cost to mine the Bitcoin. But there's so much more here in terms of curtailment, the machine settings themselves, and these PPAs or different power agreements. Can you talk to us a little bit about how energy really impacts this industry?
Well, it's paramount to it. Like my version of a data center, an analogy I love is that it's simply a refinery. So like, and to roll back, a little bit, like natural gas used to just be considered a waste product of oil and gas. You're going for the oil, you're essentially going for the kerosene, and all this other stuff was just a waste. Vent it, flare it, and then they start, and then they go, oh, this is useful. So then natural gas, and then a generator, in a large part was taking natural gas and going up the value chain. Now it's electricity. Well, now you can use it for anything. Now, as soon as there's electricity flowing over the wires, it's one of the most useful forms of energy. We can do almost anything with it in kind of our electrified world. And I just go up that value chain one more step and say a data center is refined energy. It's energy in and it's information out. So it's absolutely, it's paramount. It's the fundamental layer. It's the fundamental input, of course, to AI, but also to mining. It's probably 80% of the cost of Bitcoin mining. Obviously, AI is more capital intensive. So I couldn't say it's, 80, maybe 80% of the marginal operations, but from a capital standpoint, the HPC data center is a different animal, but it's still a fundamental input, and they absolutely need it. They have to plan where they put these facilities based on access to the energy. So they're completely intertwined. It's you cannot separate Bitcoin mining from energy, to the point where I believe that all Bitcoin miners are actually energy companies. Some of them don't know it yet. Some of them very much know it, and they're on the forefront of it. But I think all Bitcoin mining companies are energy companies. I think the most successful ones are going to be the people who are the ones who can figure that out and lean into that and have adaptive strategies. Now, there's also, it's important that there's all these really cool ways to go about this. Where are we wasting energy where we can do something valuable with it? And that's the stuff that I get very excited about. That's kind of what my company was about when I was running one, was why are you flaring this energy in the middle of the oil and gas field when you could be turning it into something useful? And I believe that it is zero sum in a positive sense, where if I'm doing that out in the oil field, then there's somebody who's actually not competing with a hospital or a school or critical infrastructure with their Bitcoin mine. So it's actually is quite a net benefit to go do that. But to your question, they're especially Bitcoin mining, energy and mining, they're intertwined. And from a mining standpoint, it's probably 80 to 90% of your costs, of your operating costs. So having a sense of it, managing those risks, having a strategy, you'd be crazy not to.
Hey, look at that segue into the next question here. Now, talking about the strategy and what Luxor offers, we've had members of your team on talk about Hashrate Derivatives, some of the products that are offered there. I saw one of the recent energy articles you co-published talking about some of the strategies you can use on the energy side as well. So potentially setting up call options or derivative strategies to help minimize the variance or the price that these miners are paying. So can you start to talk to us in a more specific sense about some of these tools?
Absolutely. I mean, so I think one of the most simple tool, you already referenced it. This has been around for quite some time, is a PPA. And all a PPA is, it's a fixed price power contract. So you're not taking, you're just reducing uncertainty. You know what the price of your power is going to be around the clock for the next 2, 3, 5 years, whatever the term that you sign up to. PPA is probably the most commonly known and commonly used tool, and you could call it a strategy, but that allows miners to have certainty of what their power costs are. Now that's kind of the first step, of like you have that in place. It doesn't mean that you can just set it and forget it. And I think that that's a piece of maturity that I've seen most of the industry. I think everyone operating in North America now knows that just because they signed a nice PPA doesn't mean that they can mine around the clock 24/7. They certainly can. That is probably not the optimal strategy. It won't produce the best results. And so that's where you can go and you can procure a fixed price cost of power. But now what that actually sets you up is now you have two revenue streams potentially, and you have a decision to make in every single 5-minute interval for the duration of that term. What is more valuable for my organization to do, for this facility to do? Should I be mining? Should I be turning should I be basically turning this electricity into information? Should I be mining Bitcoin and supporting the network? Or should I take this fixed block of power and in this interval kind of sell it back to the grid, give it back to the grid? What is the more valuable of the two? So a miner who doesn't have a PPA, they're making the same decision, but that decision is simpler in a sense that it's, do I want to make money or not? And if you're running a business, you probably want to make money. So you're probably deciding not to run when it's unprofitable. Now it's a slightly nuanced decision. Maybe you run at a 2% loss in some intervals just for operational reasons. It's just you need more staff, or it's harder to ramp the facility up and down. But if it's a screaming decision of I'm going to lose a bunch of money, well, then you're going to ramp down. And just because you have a PPA and technically you have a fixed price of power, the optimal decision is still the profit maximizing decision is still to ramp down your facility, sell back the power, take that extra bit of profit, and if you like, go buy some Bitcoin with it. That's still the better decision. So the article that we were putting out there was an educational piece, and it was trying to illustrate that. And actually, one really interesting finding of that article, and we were scratching our heads for a few weeks, but now we're 100% confident, is it doesn't matter if you have a hedge or not. The spot miner and the PPA miner are going to make the same decision in the same moment, for different reasons, but they're still going to make the exact same decision on what that power is more useful, more valuable in that moment. So that was a pretty interesting outcome of those power hedging pieces we did.
We've noticed obviously in the Bitcoin mining space, we cover a lot of the large public miners, and we noticed more and more of them switching to sort of market rate, especially in Texas. Even the likes of Riot Platforms, who've got one of the biggest PPA contracts at their Rockdale facility. I think it's 345 megawatts, and that's I think around about 3.9 cents, which is a great rate. But actually, they also have the Corsicana site, which is 400 megawatts, and they've been using that facility at the market rate. What can you, because obviously you're covering energy rates in Texas, can you give us a sort of like a view of the last sort of 12 months of how the energy markets have been there, and because we did see a few years ago, energy prices can really spike, and it can really hurt miners if they don't switch off quickly. I mean, we've seen energy prices 5,000 a kilowatt hour. Megawatt hour in those areas, and that's significantly higher than maybe the $50 a megawatt hour that miners outside of Texas are paying on a more regular basis. But can you talk about energy pricing in Texas from what we've seen over the last 12 months, and where are we seeing it go over the next 12 months? What are your views? What are your graphs telling you, the sort of like from a forward price perspective?
So I have to go back slightly further to tell that story, but I 100%. So I'm going to make a claim. You have a very intelligent analytical user base, or listening base. So I challenge your users to prove me wrong here. I want to be proven wrong here, but I'm going to make this claim that that Bitcoin miners have never made more money than Texas miners in the summer of 2003, selling back so basically Riot selling back their hedges at $5,000 a megawatt hour, and that's both true in an hour and for a day. So not forever, not for a month, but if you really zoom in to an hour or a day, Bitcoin mining has never been more lucrative anywhere in the world than when they weren't Bitcoin mining, they were selling back their power hedge. And I looked at the China ban; it's pretty close, but it's about double. They were making about double the revenue that Bitcoin miners ever made, which was probably peak China ban with the bull run. That was pretty incredible. But this window of time of the summer of 2003. 2023 in August or in
I think Rights was it was like 70 million, just over 70 million dollars just in curtailment, so selling the power back to the grid.
I believe this was the most lucrative window of Bitcoin mining ever, and it had nothing, and they weren't actually online.
Not just the Bitcoin mining industry, that was all industries in Texas who were following the same procedure with PPAs, because this was picked up by the press to say, hey, it's the Bitcoin miners, they're coining it in by turning the machines off. Bitcoin mining represented less than 3% of the whole of the energy market in Texas in 2023. But the other 97% of the refineries and of the battery manufacturers, they weren't getting any notice about it. It was just that 3% was making the big headlines in that position there. So that's good to recollect that, because I do remember having some serious. I think in August it was like $31 million. It was more than the mining revenue for the month, and yeah, we're seeing that still coming through now, but not the same levels in 2025.
And so I'm making that. So I'm going to make that claim. Would love to be proven wrong by your smart listeners.
I think you're right.
Please engage me on that one. But so what that does, but and you're also 100% correct that it's not just Bitcoin mining. You got an entire top 10 economy of the world. This is their grid. Everybody sees it. And I'm a power trader. I at the time was not in the Bitcoin mining industry. I was working at a hedge fund trading the ERCOT power market. This was, it was, what a time to be alive. Like, it was 5,000 print after print after print. And so everybody saw this. This is in everybody's head. So now to bring this back to what you're talking about for the 12 months. So the forward curve chases this. They see the hot temps. They see the hot temperatures. They see the crazy load growth going on in Texas. And so the forward curve goes, it's going to happen again. And this is completely rational behavior. How could the summer of 24 be trading at the same levels that the summer of 23 was trading before the scarcity event? It can't, right? Or if it was, it would be just a very, very obvious trade to go buy that. And so people would. And so what you do, what happened is it creates a premium. Where you can call it a risk premium, but a scarcity premium, but it creates a premium on the forward curve. Where speculatively it completely makes sense to go buy that premium, because especially if you're saying summer 24 is going to be like the summer of 23. Now it wasn't. Anyone who was long got wiped out trying to do the same thing. The summer of 24 was not completely different in terms of temperatures. We also still got the load growth, but what Texas did is they went out and they built 5 gigawatts of batteries. And that 5 gigawatts, like everything that happens in power, is on the margin, right? It's the marginal megawatt. It's that hockey stick looking curve where that's how you hit the price cap. So the difference between a $5,000 price and a $200 price, it's only a few gigawatts. Even though you're dealing with like an 85 gigawatt load, it's that extra 5 one way or the other that pushes you. So in the summer of 23, the batteries were in control. Like, they could just set the price, and they were setting the price, and they were setting the price at $5,000 because they were saying when 10 gigawatts of solar turns off and everyone's got their AC on, if you don't have us, you have rolling blackouts. And so that position, and the Bitcoin miners had the same market power that the batteries had at the time. So that was the summer of 23. The summer of 24, and so guess what happened in the summer 23? Not only did the premiums help, well, now batteries look like this amazing investment, and they build the crap out of them, and they can build them quickly, and they can deploy them quickly, and they did. And so the summer of 24 happens, and they've got all of these batteries, and they're all ready to have the market again. And then they start front running each other, and this is efficient, in my opinion, efficient market design. It goes, oh no, you're asking for 5,000, I'll ask for 4,500. You're asking for 4,500, I'll ask for 4,000, and that's a healthy market. And then what you actually got was you had so much supply in those critical windows from a trading standpoint, the summer failed. I think from a consumer standpoint, it was great. Not egregious energy bills, and so that premium wasn't justified, and all the longs got beat up. But now we've got more load growth. The summer's hot. Nobody forgot about the summer of 23, not in a single year. So you get the same premium, especially if you get like some, I think going into May we saw some pretty high prices in May indicating scarcity. Now we had a lot more outages at the time, but that same story emerges where you'd be crazy to let that strip of trade at the same levels that the summer of 23 was trading pre-scarcity, so you get a premium. So that's a lot of focus on that. But why is everyone riding index now? Why is everyone riding spot right now? Well, because of this very dynamic. There's so much premium in hedging those levels that you're basically locking in break-even economics. Why would you lock in break-even economics? Better to just take the risk, because you're essentially indifferent to being online or not anyway. You might as well just take the risk, that it's going to fail again, that the forward curve, and ride spot. That is a risky strategy for other reasons. If you go deploy $100 million of capital and you don't know if you're going to be online or not. But if the forward curve, like, that's a risk, that's a big risk. But if the forward curve is saying, well, why would you lock this in? You're locking in a very small profit margin. Then more and more miners are going to ride spot. And the other thing is, it's working. They see it's a very small industry. You see your peers doing it, and that's working for them, and then that's what you do. Like I'm a big believer in cycles. I'm not like some of the guys in the power industry with gray hair who have seen 20, but I've seen enough to know it's coming back, right? So I would say, like, wait until that premium wait until people give up on it, and then go lock it in, because that's how Riot got in that position. The reason that Riot was in the amazing position that they were in is because the market there was no premium. You could lock in $25, $35 a megawatt hour. Why wouldn't you do that? What are you playing for? For it to be 15? Lock that in. And then that's how you end up with fixed price power of $25 that you can resell at 5,000. So I wouldn't advise anyone go buy the forward strip right now and hedge. I do think you need to manage these risks, but I wouldn't advise doing that. But I also do not think that it's true that riding index, riding spot is the superior strategy. That's true of this moment. It won't be true. It won't be true forever. That's not how energy markets work. They're cyclical.
And we saw Iron do the opposite, and they took out a hedge, I think, in 2024, because I think from their position they believed it was going to happen again, what happened in 2023. So they were preventing that position. And actually, within a month, they had to buy themselves out that hedge, and it cost over $10 million just to buy themselves out, because it was a 3-month hedge, and you've got to pay out the contract. So fortunately, it was the right decision to do, because the energy price was so low, it was sub 3 cents market rate, that they were able to recover that position over those 2 months with a lower energy cost. So, but you've given there's 2 examples there where you can see how one miner successfully navigated it, and one miner who sort of, like, I'm not saying Iron's the only miner, it's just a good example, and they were very quick to be transparent about what happened. They came out and straight away and said, look, we've made a mistake. We thought the energy price was going to spike. We've now bought ourselves out of that contract, and we're on market rate. And every month they put in their energy price, and if you look at their monthly updates, it's circa 3 cents a kilowatt hour, literally month after month. Maybe 10% either up or down of that figure. So they've been doing really well. Well, hopefully, as earnings comes in now, this is when we'll start to see all these energy prices, what they've been paying over this last 3 months. And with the Bitcoin price hitting all-time highs, Haley, I mean, are you expecting sort of like some good numbers to come through from miners in terms of the fact that the margins, not necessarily operating margins, but their actual gross margins, where you just take the energy cost away from Bitcoin mining, to be in a better position? Because it has been challenging over the last sort of 5 or 6 quarters for miners in terms of this industry itself.
I do expect good numbers. I think that was so. To briefly touch on the Iron piece, there's different paths. So a contract like that is going to settle on what the average power price is, but miners, what miners really care about is volatility. So like a miner, you can buy $150 contract, and that can settle $150 or 150, so zero profit. But if one is a bunch of 5,000 hours and a bunch of 20 hours, miners love that. If the other version that settles the same, that averages the same, is a flat line of $143, that's brutal. And both those are going to average the same. The contract is going to do the same, but the intra-hour volatility is different. So not only did it not work out for iron on an average basis, but what they paid for, and I don't know if they know they paid for this or not, or if this is what they were doing at the time, they were buying volatility, and the volatility didn't pan out. So not only were they buying high energy and wanting high settles, but they were actually going long volatility.
The expectation didn't pan out, yeah.
And that's what didn't happen, like specifically in 24. Not only were the energy settles low, but there was no volatility. There was no big hours to sell back. It was just kind of, so that was a piece there where, and again, that's like part of the education piece or part of the strategy that plays a little more into, the options stuff. But a month that settles $50 and a month that settles $50, they're not the same. So it's not just the outright energy price or the average energy price. It's the intra-hour volatility where miners can really benefit, and what miners want to sell when the market puts a high premium on the volatility, and when there's no volatility, they want to buy that. On the financials, like I think this has actually been a really good run. We're seeing hash price kind of, keep ticking up to $60 again. That's great, right? So I think people who bought S21s in particular, like this is kind of the gambit of being a miner. You spend a lot for in a lot of ways, it's like the people who make all the money are the people who sell the chips, right? Because if Bitcoin price goes up, well, then you just increase the price for the machines. So this is the hard part about being a miner is like, okay, you're in a bull run, great, but now this treadmill of equipment that you're on, you have to put up all this capital for the new equipment, and it's very hard to buy the equipment in a bear market and deploy it in a bull market. That's the dream. But in particular, I think people who bought S21s are doing really well. Like this has been like a good run for them because the hash price keeps going up, which means that it's highly likely that most people who got them early have paid them off, or mostly paid them off. And that's what you need as a miner. You need to kind of get ahead of this equipment recapitalization treadmill. And so like I do expect good financials for to come in.
That's great. Yeah, it's interesting. Although the average price comes out the same, that inter-hour volatility, and we've talked about curtailment on the channel and the ability of these miners to ramp up and down basically in a moment's notice to adapt to that volatility. Now, in closing here, I know we've covered quite a bit, Haley. I wanted to give you an opportunity to talk about Luxor's specific product suite that's coming in the energy space here. I visited the website. I was taking a look under the derivatives tab. I looked over at the energy one. It's listed as coming soon. So obviously a lot of construction underway. You talked about some of those tools in the intro there. Can you give us as much detail as possible about what to expect next?
Luxor we very much like to think of ourselves more than a Bitcoin mining pool. That we like to serve the whole industry, any pain points, and so getting in and energy being so important. We're trying to do it right, and we want to be a one-stop shop for Bitcoin miners. So that's what we're trying to bring to market. As I mentioned, we can now issue a power bill directly to two data centers, directly to a mining customer. So now you're going to have your revenue coming into the same portal where you're going to be able to see your costs. You're going to be able to see that for on the reporting standpoint. And we're trying to open the doors and make it as turnkey as possible to participate in demand response, ancillary services, capacity markets. So basically through a single portal to be able to, well, that's, already that's where your hash rate is going and being monetized. We have the ability to kind of lock that in and hedge it on the derivative side. And on the energy side, you'll be able to manage your energy bill, look at your energy bill, line it up with your revenue, and participate in programs where you get a little extra revenue by participating in these existing programs. We're starting off in ERCOT, so that is where we're starting. But we'd love to hear from people who are in other North American power markets. We're trying to figure out where to go next. But the tool suite should be a one-stop shop to kind of manage all your operations, all your finances, all your risks in a single dashboard, a single platform, and really make it easy for miners. So it's not daunting. You don't need to go hire consultants. We can walk you through the process and say, hey, do you want to get paid for your flexibility, right? Do you want to get paid for your ability to ride this volatility, lock in some certainty, or get some, or unlock a new revenue stream? So that's what we're trying to bring to market at Luxor Energy.
That's great. Yeah, we look forward to continuing to watch that evolve. The industry is maturing so quickly, and we're seeing so many new products and tools come into the space. So it's great to hear that your roots were in mining. You're building this from the ground roots up for miners, by miners at Luxor. So that's great. Excellent interview today, Haley. I learned a lot during the discussion. I'll give you the opportunity to close out if there's anything we missed, but really appreciate the time.
Oh no, I mean, like we covered a lot of ground, and I guess just that all Bitcoin miners are energy companies. So like if you are a Bitcoin miner, I'd lean into that mindset. I'd think of your facility as a refinery, as an electrical refinery, and understand that you're already in a commodity game, whether you want to be or not. It's a commodity game. ASICs are commodities. Power is a commodity. SHA-256 hash rate is a commodity. You're in a commodity game. You don't need to reinvent the wheel. You can look at what all these other mature industries are doing, and Luxor's trying to be on the forefront of that. So if you want to beef up a commodity strategy, I'm happy to have a conversation. But even if it's not me, I think that mindset, that maturing of the industry, which I'm watching happening every week, to just lean into that because it's happening. And I've got a view that there will be no vanilla PPA warehouse miner in 5 years. That's kind of, that I know there's a lot of companies that started off that way, but I think that you need an energy strategy. It needs to be innovative. It needs to be grid participation or upcycling heat or going after stranded energy. And I view that as the future of Bitcoin mining, and also the anti-fragile future of Bitcoin mining, where you're not subject to regulatory whims. So yeah, that's just, the more I see that mindset kind of take over the Bitcoin mining industry, the more optimistic I am about it. So that's kind of the approach that I'm personally taking in my role.
Great. Well, a very fitting end to the conversation. Thank you again for the time, you guys. If you have any additional energy-related questions, both at a general level or specifically about Luxor products, feel free to leave them in the comment section below. We'll link the website as well. Hit the like button. Feel free to subscribe. We'll see you back here tomorrow.